Are you worried about runaway inflation? Well, hopefully this video will set you at ease. And now we'll briefly talk about you for a second. You've clicked on a thumbnail about inflation, so I think I can fairly assume that you've seen many other YouTube videos that are setting the panic stations about how inflation's ramping out of control and we're going to end up just like Venezuela. Loaves of bread are going to cost $1 million and we're going to be starving billionaires and we all need to panic and everything's doom and gloom. No, in reality, it is actually a lot calmer than this. You may have seen a bit of a clickbait headline, or you may have read a quick article about the Weimar Republic, Venezuela, or Zimbabwe. But the people that are running these reserve banks, in both the Reserve Bank of Australia and the Federal Reserve, they haven't just read the clickbait articles. They've actually read and studied these history in extensive detail. Furthermore, they've actually done PhDs on the exact causes of some of the major economic events in our history. So the head of the US Federal Reserve, Jerome Powell, and also the head of the Australian Reserve Bank, Philip Lowe, had backgrounds that are very similar to what I just described. And so when you say, oh, these people are idiots and they're just printing money and they don't know what they're doing and we're going to end up just like these countries that have stuffed up in the past, do you honestly think that they have not actually considered this history themselves? And also, they don't just make decisions on whims, they actually do things based on mathematical formulas. It's not just saying, oh, I think things are going bad, I better just print more money. No, they actually work very closely and very tightly with money formulas, and they see if one variable is moving or then they need to adjust another variable to keep things steady and smooth. And right now, I bet you're thinking, well, why is it then, if they're so smart, that they're doing the exact same policies that led to economic inflation carnage in the past, why are they doing that again? And now I bet you're thinking, how did you know I was thinking that? I've just gotten 2 for 2. Well, the secret is that I'm actually psychic. Well, when COVID started and the lockdowns came in and the production chain was halted, reserve banks of the world, they were left between 2 wrong choices and they had to pick the least wrong of the 2 choices. So on one hand, they could do nothing or very little intervention. It'll cause a bit of a recession. But the problem is that'll then trigger a deflation, and then that deflation will then trigger a depression. You know, that thing that happened in the 1930s that was pretty full on and pretty bad? Now, so what'll happen here is that businesses that are on the edge, they'd go bankrupt, and then they wouldn't be able to pay their bills. And then that'll cause a domino effect, because then businesses that are actually on their own totally healthy would then lose the revenues that are owed to them, and then subsequently drive them to go bankrupt, and then they wouldn't be able to pay their bills, and then they'll go bankrupt as well, and it'll just cause this massive domino effect that'll just cause mass and carnage. And unfortunately with recessions, when they happen, it is a very miserable time. Suicides are up, crimes are up, everything sucks. And it is not a very good condition to live through. The 2 most prominent examples were in the 1930s, basically around the world, but especially in the US, and the only way that they were able to get out of this was when World War II broke out. And it also happened in France in the 1800s, and the only way that this ended for France was when the conditions actually got so bad that it triggered French Revolution. And another really bad thing about a depression as well, the Federal Reserve or the Reserve Bank or whatever the head bank is, they actually lose control. When the depression actually starts, no matter what monetary policy that the Reserve Bank tries, nothing will work. People just hoard all the money, they stuff the money in mattresses, and basically the Federal Reserve has lost control. Historically speaking, when these depressions happen, they either leads the country permanently into ruin, or they're saved by a massive war. And neither scenario for this is good. Or they can go the other way. They can actually choose to carefully and very precisely stimulate the economy, and if they go down the inflation route rather than the deflation route, the most important thing here is that the Federal Reserve actually has complete control of the situation. They can wind it back, they can ramp it up, and they can basically change the accelerator on the money printing depending on how they see fit. However, if it went down the depression route, they'd have no control. And like and subscribe, please. So, how do they decide how much they need to lower or raise the interest rates, and how do they decide how to increase or decrease the money supply? Well, they actually use this formula. It is prices equals money velocity multiplied by money supply divided by GNP. And the GNP is basically just the size of the overall economy, and I won't go into too much detail about that because I don't want to overcomplicate this video. We got money velocity and money supply. So when COVID started, with the lockdowns and with the supply chain issues, this obviously is going to cause a massive plummeting of velocity. But what is money velocity, I hear you think? That's right, I'm psychic. Well, money velocity is how often money is spent. So as an example, let's just say that I had $20 and then I decide to walk past a cafe because I feel like a coffee. So I give that $20 to a cafe, and then the staff at the cafe, after they finish work, they decide to get lunch somewhere else and get a pizza. And then afterwards that pizza shop decides to go out and use that $20 to buy premium ingredients instead of a standard ingredients to improve the business. However, if money velocity was low, I'd think, ooh, I'm running a bit low on money and I'd really like a coffee, but I better save my money, so I'm going to keep it in my wallet. And so with money moving a lot less, this is a big thing that happened at the start of the COVID outbreak. Now going back to this formula, you got the prices with money velocity with money supply. And now money velocity is plummeting. So in order not to send this equation into a chaotic spiral, they basically have to work out how to increase the money supply by the multiple velocity is going down to keep this numerator consistent over the denominator to keep prices steady. And as far as how they actually increase the money supply and how they change the interest rates, well, that is a very complicated subject that would require its entire own video. So I'll just simplify this and say they'll increase the money supply. So the money velocity has gone down, and then to balance it out, they purposely increase the money supply and then divided it by the GNP, and then prices are steady. And another thing we have to bear in mind with this formula is that with the COVID lockdowns, the money velocity was temporarily driven down and the money was permanently added into the supply. But as COVID starts to wind down and everything starts to finish up and the supply chain's opening again and money velocity is starting to increase again, this new money supply is already circulating in the system. So as the velocity starts to increase back to its normal levels, we're going to see a bit of the temporary, or the word they use is transitory inflation, because of the money that's already circulating in the system. So before, when it did this balance where the velocity was low and the supply was high, now we're seeing the situation where the velocity is starting to go up again and the money has already been injected into the system, so it stays high, and now we're seeing a little bit of temporary or transitory inflation. But don't worry, everything's not lost here. Very easy for the reserve banks just to tighten up the future money supply, and then that'll sort of correct it downwards a little bit, and we'll have a little bit of a bumpy ride for the next couple of years. But the key thing that's going on here is that they're trying to level it and smooth it as much as they possibly can. So yes, there are some inflationary forces right now that the heads of these Federal Reserve and Reserve banks are trying to deal with. However, there are also deflationary forces at play as well that they have to balance out. And as you may remember from the start of the video, deflation is worse because that could potentially lead to depression, which then can cause basically a financial apocalypse. What are these deflationary forces, I hear you think? That's right, I don't need to say it again. In a lot of the Western world and in Australia, we're actually facing a bit of an aging demographic problem. So what this basically means is that we're going to have more people retiring out of the workforce than 18-year-olds that are jumping in to join the workforce. And so with this in mind, there's going to be less people putting money into the economy and more people taking money out of the economy. There was a 2018 report that was forecast in the next 10 years by the Parliamentary Budget Office. And what this budget forecasted was that in 2028 compared to 2018, there's going to be a budget hole of approximately $36 billion that we're going to need to deal with in the next 10 years. So this is a massive deflationary force that the reserve banks need to counterbalance as well. So how have we not already been affected by this massive deflationary force? Well, there's two main reasons. So the first is that we had a little bit of good luck through the European Central Bank and also the US Federal Reserve increasing the money supply through quantitative easing and through lowering the interest rates for their own reasons and for their own problems, which Australia happened to benefit from because it kind of suited the problems that we're facing as well. And the second reason is that the Australian government actually saw this issue coming and they actually opened up immigration a little bit. And so to compensate for the amount of people retiring and the pressure that's putting in our economy, they've actually offset it by allowing for more young immigrants to get in and then offset the amount of people that are exiting the economy by having those immigrants be the replacement for them in the economy. So just to summarize everything up, there is a very delicate balancing act that the US Federal Reserve or the Australian Reserve have to do in order to balance out the inflationary forces and the deflationary forces. It is a very tight balancing act. And the second key point that I wanted to get across in this video was that the people that are maintaining this balancing act, they're highly experienced, they're very well educated about the history of monetary policy, and although we're facing some challenging situations and they may not always get it right, they're probably making better calls than what you or I could have made.